Imagine two investors watching the market collapse on the exact same day. The news is filled with panic. Financial experts are warning about recession. Stock prices are falling faster than anyone expected. One investor looks at his portfolio, panics, and sells everything because he believes the market will never recover. The other investor does something that feels completely irrational. Instead of running away, he invests every dollar he has available. 20 years later, one of these investors is still trying to recover financially, while the other has built remarkable wealth. So what if you only invested every time the market crashed? Would that actually outperform regular investing, or is it simply another financial myth? Hi, I'm Amrith. Most people think market crashes are something to fear. Whenever headlines start talking about bear markets, recessions, or financial crises, investors naturally become nervous. It's understandable. Nobody enjoys watching their investments lose value. But history tells a very different story. Some of the greatest investing opportunities in modern history have appeared during periods when almost everyone else was terrified. Let's go back to the year 2000. The dot-com bubble had finally burst. Technology stocks that had climbed to unbelievable valuations suddenly collapsed. Companies disappeared almost overnight, investors lost billions of dollars, and confidence in the stock market vanished. At the time, many believed technology investing was finished. But investors who continued buying quality businesses during those difficult years eventually benefited from one of the strongest bull markets in history. The same pattern appeared again during the 2008 global financial crisis. Banks failed, unemployment surged, and fear spread across financial markets around the world. The S&P 500 lost more than half of its value from its previous peak. News headlines suggested the financial system itself might collapse. Millions of investors sold their portfolios because they believed protecting what remained was the safest decision. Now imagine someone invested $10,000 during that period instead of selling. Over the following decade, as markets recovered and continued reaching new highs, that investment multiplied several times over. The difference wasn't extraordinary intelligence, it wasn't insider information. It was simply the willingness to buy when everyone else was afraid. History repeated itself once again in 2020. The COVID-19 pandemic caused one of the fastest market crashes ever recorded. Within weeks, stock prices collapsed, businesses closed, and uncertainty dominated every financial headline. Yet the recovery that followed became one of the fastest in market history. Investors who remained disciplined and continued investing during the crash experienced significant gains as markets rebounded. This raises an interesting question. If crashes have historically created incredible buying opportunities, why doesn't everyone simply wait for markets to crash before investing? The answer is timing. While buying during crashes has historically produced strong long-term returns, predicting exactly when those crashes will happen is almost impossible. Markets can continue rising for years before experiencing a correction. An investor waiting entirely in cash may spend years missing strong returns while expecting a crash that hasn't arrived yet. Imagine two investors, each starting with $100,000. The first invests immediately into a diversified S&P 500 index fund and leaves the investment untouched for 20 years. The second decides to wait for the next major crash before investing. If that crash doesn't happen for 3 or 4 years, the first investor benefits from years of compound growth, while the second investor earns almost nothing sitting in cash. Even if the second investor buys during a crash, he may still struggle to catch up because he missed years of market appreciation. Research from several long-term market studies consistently shows that time in the market usually beats trying to time the market. Missing just a handful of the market's strongest recovery days can dramatically reduce long-term returns, because many of those powerful gains happen immediately after periods of heavy selling, exactly when most fearful investors are sitting on the sidelines. That doesn't mean market crashes should be ignored. In fact, many experienced investors prepare specifically for them. Instead of keeping all their money in cash waiting for disaster, they continue investing regularly while maintaining additional cash reserves that can be deployed whenever significant market declines occur. This strategy allows them to benefit from long-term compounding while still taking advantage of discounted prices during major corrections. Think of a market crash like a store-wide sale. When televisions, smartphones, or laptops suddenly become 30% cheaper, people rush into stores because they recognize a bargain. Yet when shares of profitable companies become 30% cheaper, many investors panic and run away. The psychology is completely reversed, even though the opportunity may be even greater. Of course, not every company recovers. Some businesses disappear permanently after economic downturns. That's why experienced investors rarely concentrate everything into one stock. Instead, they diversify across hundreds of companies using broad market index funds or carefully selected businesses with strong financial foundations. Another important lesson from history is that every crash feels different while it's happening. During the dot-com crash, people believed technology investing was over. During the financial crisis, they feared the banking system would collapse. During the COVID crash, they worried the global economy would remain closed for years. Each crisis felt unique, yet the long-term pattern remained remarkably similar. Markets eventually adapted, businesses recovered, and long-term investors were rewarded for their patience. This doesn't mean investing during crashes is emotionally easy. Watching markets fall by 20%, 30%, or even 50% tests every investor's confidence. That's why successful investing depends as much on psychology as it does on financial knowledge. Investors who remain calm during periods of uncertainty often outperform those who constantly react to headlines and short-term market movements. So, what if you only invested every time the market crashed? Based on historical research, you would likely make some excellent investments. But you'd also spend long periods sitting in cash, waiting for opportunities that may not arrive for years. That's why many financial professionals prefer a balanced approach. Invest consistently regardless of market conditions, while taking advantage of major crashes by investing additional capital whenever exceptional opportunities appear. The biggest lesson isn't that crashes should be feared or celebrated. It's that market downturns are a normal part of long-term investing. Every major crash in modern history has eventually been followed by recovery, innovation, and new market highs. Investors who understand that reality stop viewing crashes as disasters and start recognizing them as opportunities to buy quality assets at discounted prices. At the end of the day, wealth isn't built by predicting every market crash. It's built by remaining disciplined when everyone else becomes emotional, continuing to invest when uncertainty feels overwhelming, and giving compounding enough time to work. History has repeatedly shown that while crashes create fear in the short term, they have also created some of the greatest wealth-building opportunities for patient investors willing to think beyond today's headlines. If you enjoyed this video and found it valuable, make sure to subscribe and turn on notifications for more content on investing, personal finance, and long-term wealth building. Thanks for watching, and I'll see you in the next video.